We will be 40 trillion before the year end. And who are these big buyers? They are being financed by repos, overnight, daily repo funding and the money market system. You just get the future move away from the cash markets, and they will not have the margin to hold it up. It becomes systemic, too big to fail. Fed has to stand in. It's a long-term capital markets parallel as well, because they put the entire system at risk, and therefore you create the next bailouts.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 27th through November 3rd, 2025, while supplies last. First this week, 1-ounce gold Valcambi Combi Bars that can be broken into 10 1/10-ounce bars are just $215 over spot. Next, 90% constitutional silver is just 30 cents over spot per ounce. Finally, assorted silver rounds are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Francis Hunt, the Market Sniper. Francis, thank you so much for joining us today.
Always a pleasure. Delighted to be back with you, Elijah.
Well, it's great to have you today. As we're seeing this pullback in precious metals that's lasted a couple weeks now, I wanted to get your perspective on that. But first, you've also been touching on a really interesting story about US Treasuries in the Cayman Islands and how it seems like, there's arguments out there that there's robust demand for US Treasuries right now, but it seems like a lot of it is actually coming from, it might be kind of artificial demand. And can you expand on that and how the Cayman Islands plays in with this as well?
It's an incredible story, Elijah. And like you, I have my suspicions. As much as I don't wish any ill on America, I have my suspicions surrounding people that comment about a great auction for treasuries again today. You get a lot of this, all these people talking about, the dollar's under threat. Look how well demanded the treasuries have been, et cetera, et cetera. And there's been recent revelations, but it's worth also putting why these recent revelations have come out. There was an event in April that was very specific to the gold market, and I'll tie all this back to gold because I don't want people to think that we're just going on a journey in the wilderness here. This is a gold story in the end, and a silver story, very, very strongly so. In April, at what we called and named peak Trump tariff tantrum, which was when the very first time he was getting super aggressive and levied triple-digit type tariffs across the broad spectrum of nations, but the ones on China being probably the most significant due to the trade relationship that is held there. We ended up getting an event that saw treasuries spike down in value, rates spike disproportionately up. And I will show you that event on the charts when we refer to the technical section in the second half of our chat. But I want to put that landmark for everyone to remember. And of course, what also happened, which brings us back to gold, and I will be tying, once I've taken you for a little bit of a walk in the wilderness, I'll be tying this all back. Gold ran, having done our target of 2,900 and 3,000 that we had suggested when we were down at 2,000 on your channel. Gold had a surge from the 2,900, smashed right up to 3,500. And that was its peak. And then we got put into an April till September continuation pattern that recently broke out and led to the 3,350 runs right the way through for another $1,000 to the high end of 4,350s. And since then, we're having our pullback. But going back to that April moment that was super, super violent, what was really behind that? We called it peak Trump tariff tantrum. And the great irony about that is Donald Trump came out and said, without being prompted, I don't know how this came out, but ended up saying, we weren't worried about the bond market. Now, what's happened since then is the Bank of International Settlements, which, for those that aren't familiar, is a Swiss-based central bank to all central banks, highlighted that there is a crowding out and real systemic risk brought about by a very crowded trade, a very highly leveraged crowded trade. And that trade is what's known as the basis trade. So a top line, everyday man's explanation of the basis trade without losing ourselves too much in fin speak and gobbledygook jargon is basically the following. Leveraged hedge funds buy treasuries. They do so with great leverage, so they're typically putting 1% and 2% maximum down. They are being levered up, essentially 100x, and are holding this. They are then pledging it as collateral, and then they are securing further leverage. They are shorting the futures markets, which typically trade higher than futures are basically, particularly on bonds, it's just fiat, but it's fiat with a delayed delivery. So it's all about fiat. Even debt markets aren't really debt markets, they're fiat markets. We say we merge the two back together. They're Siamese twins, but they're one and the same. But it's just delayed delivery fiat, a bond. That's all it is, with a maintenance cost. So in essence, they are shorting futures on the basis by the time the expiry comes, the futures typically come back down and meet spot on delivery day. There's no point in buying a more expensive future for delivery the same day if you can buy a spot cheaper. So invariably they come down. So they're shorting the higher line that comes down and buying the undervalued assets. So many will say, well, technically they hedged because they're long the same assets that they are short. The problem comes in is most markets have what's called contango. That means the future delivery costs more than the present ownership. There's in things like gold and oil, obviously there's storage costs. When you're talking about paper money that is all digitized, it's more about opportunity cost and also interest rate costs and maybe a little bit of inflation that creeps in there. As well being priced in. So they are getting a very meager return. It's not a great trade. Particularly, it's a very meager return. How do you maximize a meager return? You apply a huge amount of leverage on it. But there's also costs, and in the financial running of this basis trade system, they are pledging the collateral. They're even letting go of ownership for it for a while and financing with the repo market, which brings in the intricate plumbing. Repo markets are the interbank lending, where excess deposits can be lent to other banks at a low liquidity levels overnight just to shore up a short-term cash need. So you have all of this interbank plumbing that typically doesn't affect you and me in the streets. Of course, it also extends into money markets. Now, just an aside, not specific to the basis trade, Warren Buffett is getting a lot of attention for having one of the biggest holdings in the money markets. I think he has in excess of 300 billion in the money markets, where he's earning around 4, possibly a bit more, % on that on an ongoing basis because he's unhappy with equity valuations. So he is providing liquidity technically via the money markets. For interbank lending, his bank can make up those excess deposits available to other banks that might be short. And all of this is a funding mechanism for aggressively levered through the primary dealers who are facilitating the hedge funds for putting this trade on. And I compare this to subprime. The only differences is subprime, you and I as man in the street got to see. We had a friend at the dinner table who had 10 apartments but didn't have the money for one. He just put a good faith deposit, a very menial one down. Somebody even got 100% finance or even beyond 100% finance. We could see there was something odd going on. This is all inside the bowels of institutional banking, primary dealers, repo markets, money markets that most people don't understand. And there is excess leverage building up there that's likely to cause a repo crisis or a money market crisis. And this is so systemic. The point of BIS that brought this out about what's going on in the basis trade that prompted the Fed to reassess how much treasuries are truly held by the Cayman Islands, and saw that an already big whale in treasuries was understated was only 25% of the position they truly had. In other words, 4x the true value. So here you have a tiny Caribbean island. You're talking about a speck of an island that has 7.1 billion as of 2023 GDP. Now let's just say 7.1 billion GDP is the equivalent to a man's income for a year. If you were on 250,000 a year, Elijah, you would have, and you were the Cayman Islands, so your 250,000 is equivalent to 7.13 billion. They have 1.8 trillion in US Treasury exposure. That would be the same as you, with your $250,000 annual gross salary, having 68 million bond portfolio. Now, I think you would be thinking that if you were on that income, you might have a bit of gold, you might have a silver. It would be quite unlikely that you'd be deep in the 7 digits on anything on $250,000. You have a bond to pay, you have other expenses, etc. on $250,000. But 68 million bond portfolio is deeply improbable with that level of income. That is the scale to which the Cayman Islands has become this bottomless pit buyer of what I consider to be Ponzi-onomics, which is 1 trillion every 2 months. We've just crossed into 38. It was 2 months ago, we crossed into 37, and it's escalating. We will be 40 trillion before the year end. It starts with a 4. And who are these big buyers? They are being financed by repos, overnight, daily repo funding, and the money market system. And it's a crowded trade, and all you need is for futures to go into backwardization instead of contango. They are so leveraged, and they consider it such a certainty, and they've all been jumping into the space and getting these returns. You just get the future move away from the cash markets, and they will not have the margin to hold it up. It becomes systemic, too big to fail. Fed has to stand in. It's a long-term capital markets parallel as well, because they put the entire system at risk, and therefore you create the next bailouts for. It's not even for retail. Socialized cost on the rest of us, major profits. The people who will gain out of this folly, though, and how do we ensure ourselves, is gold. The point at which we had this event in April, it's worth showing you what gold did when all of this had its wobble. That has led to all these recent exposures that we are now discussing. It was this period here that saw this huge run-up. Doesn't look huge now, given what's happened since. But we had a surge from the 2.9s to 3.5. $600 on $2,900. That was literally a 20% move, and they quickly went into mini behind-the-scenes crisis. Many of people aren't even familiar that much was going on, but Trump did make that rather telling statement. Did you have concerns about the bond markets? It's worth also showing you what the benchmark US 10-year did, of which housing finance is so reliant on, Elijah. And that was this period. You should see it immediately pop. This was gold at 2,900, bang, gold at 3,500. And as much as there's been talk of cuts and everything is recessional and soft, which it is, in my opinion, you have yet to make the pre-basis trade wobble lows. We've been in a long, slow comeback with terrible news on employment. We've had some shocker non-farms. We didn't get a non-farm because of closure last month, but before it, we had 2 in a row, very, very hard hits. You've had Trump putting pressure on all of that. You've yet to get back to the rate level on 10-year treasuries that you were at here just prior to the basis trade wobble. So this just goes to show the sensitivity. And to complete this, I want to show also the Dixie, and then I'll hand back to you because this has been a long narrative that I've unloaded on you. But that was what happened to the dollar index during that same period. The harshest part of the adjustment, it had already started at March a little bit. You could see it as soon as we hit April. That was a very, very violent sell-off. Dollar went down, treasuries went down, rates spiked, gold, and this is a gold story. I told you I'd bring it back. 2,900, zip, suddenly 3,500. So let me get back to you and let you come back at me any way you choose.
Definitely. So it sounds like, I mean, during that transition there, you had rates falling significantly, the dollar falling, and gold spiking. Now, as we stand right now with what's happening in the basis trade, what do you expect for gold going forward here?
I am putting an amber light out there saying your next major financial crisis may have this theme on basis of what my research has shown me. And I'm not the only one, by the way. There's other people that you can follow that have picked up on this. And I did get some which profile was it? There it is. There's a gentleman here who's also been covering it, I think is worthy of a mention, and that is Jeffrey of Graph Call. He's been putting it out, and I've been reading his takes on top of our Substack takes, and he's bang on. And the interesting thing is, this is a very useful formula. I like how he summarized this. The US government spending $2 trillion more than it collects. Yes. Hold on, where's the one I'm looking for? This is the key thing. The more bonds are issued, let me just put this in the pink box here so that it pops for everybody. The more bonds issued, the more leverage buying is needed through the basis trade. The more demand for repo loans, because they don't have the money to buy the bonds. There's such big amounts. They are hyper overvalued. They should be trading a lot less with much higher interest rates. The bubble and the controlled market is the debt markets, nothing else. And debt fiat is the foundation. Everybody wants to talk about stock markets and everything else. Those all sit like layers off of the foundation. The debt fiat system is the foundation. The more bonds issued, the more leverage buying, the more demand for repo loans. Upward pressure on short-term repo rates. That makes it very hard for rates to go a lot further down because you've got this liquidity suction that is being put on the repo markets. And that builds systemic risk. This part of this tweet as well, that the gentleman, Jeffrey, did put down, highlights that and I like some of the phrases. I'm just going to change glasses for the reading of it. This is the BIS. The government's bond markets at its center and asset managers of various stripes as key intermediaries. As a result, the key risk today is liquidity stressing in government bond markets. Hedge funds in particular become key providers of pro-cyclical liquidity in government bonds markets, often employing high leverage relative value trading strategies by using government security as collateral in the repo market to borrow further. So haircuts have gone to zero. So haircuts are when you require a kind of a deposit. You take something. They've gone to zero and even negative. So you can actually pledge collateral and get more lending back. Just think about this, Elijah. Imagine I took your house and wanted to get you leveraged and it's worth $500,000 and I say, pledge your house, I'll give you $600,000. Go buy another house, you buy another $500,000, you still have $100,000 left over, I'll give you another $600,000 for your collateral. You are slowly accumulating. Instead of buying 500 grand houses, you now start buying 600 grand houses and you're still cash flow neutral. So by getting negative haircuts means they're allowing people to borrow more than against that collateral. So this is complete non-underwriting standards, much like, which is why I compared it to the auto bot signing on ninja loans in subprime. But it also has a long-term capital vibes about it because it's systemic of risk. That was one of the first that brought systems. Haircuts have gone to zero, meaning the creditors have stopped imposing any meaningful restraint on hedge fund leverage. So they've gone complete pants down on regulation. And of course, you don't have to co-opt S&P and Moody's for this because none of that is being regulated by the ratings agency. This is dealers brought about hedge funds and primary dealers directly. This high leverage leaves the broader market more vulnerable to disruptions, and even slight increases in haircuts can trigger forced selling and amplify financial instability. So we are watching, in my opinion, the next stage of gambling the entire system for the eventual, for maintaining the existing Ponzi, basically, which is treasury purchases. There is no one with $1 trillion every 2 months. Nobody has that kind of income. Even China, with all its trade, doesn't have the means. I think they topped out in total around $1 trillion, and they sub $1 trillion today on all-time accumulation of treasuries. And there's a new trillion every 2 months. So who's been the buyer? Well, we also had the French and the UK, I call them the slave nations that are tied to the post of the Western hegemony. The only thing that's good for the collapse for America is that they won't be alone because they're going to drag down the entire Western world that is bought into the same Ponzi. And that's where we are. I don't know if that helped give you some more color, but it is the financial leveraging of the system has created fake demand for an asset that is of dubious quality and for which there appears to be very little regulation in between, and they are putting the entire system at risk again.
Now, that certainly is, I guess, a long-term outlook then. Is there's artificial demand right now for US Treasuries. So obviously there will be less, if there's really only real demand in the future, then demand will fall for US Treasuries because, as you mentioned, not everyone can buy $1 trillion every 2 months of US Treasuries. So that would be certainly bullish for gold long-term. However, in the short term here, we're seeing quite a bit of a pullback over the last couple of weeks. So I wanted to get your perspective on the charts. What do the charts look like at the moment for the short term? What do we need to see in order to really call bottom in both gold and silver?
Yes, let's go back to the gold chart and talk about current movements. So we were going up exceedingly quickly, Elijah. I mean, the rate and pace of it, and also the gain in market cap was substantial, was absolutely substantial. We mentioned, let me use a slightly smaller line than that. We mentioned this breakout was going to be a key opportunity. It was one of the best since our 2000 to 3000 call. And it gave us a fake run here that caught us out. We had a little bit of red and then we came back and we leveraged long here. This has been an outstanding trade for us. And it's been a major run up, but it did start to go up excessively quickly. And we've had a pullback. So we're on the daily time frame. I can say for the day, we washed out to the low and it's been bought back up. This is a little bit of a hammer. Now you've already had one hammer here. Let's make this a bit more visible. Let's reduce the history and so that no one has to look through magnifying glasses to see what I'm saying. You did get a bit start of a hammer and it slowed there, but you still fell a little lower. We had reasons to believe that this is going to play out. This was quite a violent sell-off there, given that you'd done so much. But I don't think there's too much more. There might be one more selling leg potentially. So when we put our technical analysis on this, we're highlighting, by the way, that you have sell-offs all the way along. And back, you've had 10% in April after the 3,500. You had over 10% correction as well. And that ended up setting up a continuation pattern. So if we look at this, sometimes you get 3 waves of selling. The first one was ignored. You rallied all the way back. That could be your second, and then you've had a grind down low of third. That could be one way of reading it. We think that's possible. We can't say for sure because maybe the selling only started. This went so high, this was double top. So we felt that there was a down leg to here that got made. You then had a continuation pattern develop there. So, I mean, to a degree, I'm explaining what's already happened, which is typical of technical analysts. But the key point is it drops key levels for you along the way. So if I draw that inverted HVF structure, we felt that you were going to fall a little lower. So in our community updates, we said you've got to run that target down here. That's now been done. So you've made a double top pattern break on a target. You've got a rally that sets up this continuation pattern, which is still a bear trend, short term on this time frame. We're talking 2 hourly, certainly not weekly, monthly, daily. And that squeezed and broke, and that's also made its target. So we think you're going to be choppy. We're not yet ready to call a bottom, but we think you'll be choppy, a little bit of a rally having made some targets. There was one wild card. I don't think it's a strong likelihood. It's not my base case, but we almost glad that this traded deeper here than there. It would have been more dangerous had we supported here, that 3,950, because there was a slight possibility at that point for a possible head and shoulder. The trade lower here by not accentuating any support here has almost to a degree been better. Had we bounced here and put a weak rally, it would have opened up the possibility of a far larger reversal. I think we've to a degree negated that, but we've still got to sit this one out for a little bit. I think it's great time for dollar cost averaging and accumulation, not for leveraged long trading yet. I don't want to catch a falling knife, but at most I would, if even in our worst case scenario, I think if you rally here, you might have a third. We typically have 3 waves of selling, and the interpretation is probably we can't count this first hit So maybe that's just the first wave of selling and that's the second. So we could have a rally and then one more dip. Typically, the sell here was less aggressive than the first one. So it's already reducing by amplitude. So we're not calling a bottom yet, but you have just run a technical target. And I think the chances of it being a bigger head and shoulder are greatly reduced. It's worth doing silver as well, even though gold is the leader. But it's nice just to get a little bit of a feel also on silver. We drew the same thing with the possibility of a head and a shoulder, but we don't think this one's coming. This is, again, a very small left shoulder. So the same, if gold did break down into that head and shoulder, silver would have a pretty similar one. But this is quite disproportionate. It's rare that you get such a big head and two tiny shoulders like that. So again, gold will be the determinant, but we're not ready to absolutely say that it's a bottom yet. I just think it's a great opportunity for accumulating, but this head and shoulder is not my base case. I think with silver, you have had 3 waves of selling. That, which did give a head and shoulder, by the way, we generated that target, and that target has also been run. So that's the head and shoulder there. That was a nice little bear flag. We pointed this point out to our community, and we were actually getting out over there. We didn't like it because you'd had expanding volatility in here. So it did look toppy at this point, and we managed to miss at our leverage trading, thankfully, though, that big sell-off. Again, a little bit of continuation, also set up some form of a target. Those have all now been made, and now you're getting a little bit of rally. Not quite ready to call the bottom yet on it. I will show you platinum as well, because it seems to have diverged a tiny bit. Let's just do that. Platinum, and minus the O there. It appears to be a tiny bit stronger. And I think it's the next, once we based and we surge, I think we're going to get another period of outperformance here from platinum. If we look at it from its worst moment to where it is now, that was its high. And it's very rare. It's only 7.84% down. If I take you back to that silver chart, let's do some measurement for you how far. Isn't it ironic? Bitcoin's been trading more than double teens down from its high, but everyone on gold and silver at about 7% down is calling the fact that there's a big trade rotation. I always find that interesting. So silver is 13.5% down, platinum is less so, and I think that's a relative strength indication of it. Also a very thin market in it, and we are seeing there was, for example, one South African platinum mine has been closed because the price isn't higher enough. They won't reopen it until prices are significantly higher. And platinum is South Africa and Russia generally as a corner. Gold is 9.41%. So the interesting part of this is platinum is a relative overperformer in this down leg period. And I think the next surge, it could be a star again. So it's worth watching. So gold 9.4. Let's get the number on Bitcoin, shall we? Because as I say, there's been quite a lot of algo forensic chatter from the Bitcoin group of friends. You're about the same percent down. You're 8.6 versus 9.4. Now, I will concede that Bitcoin is a higher beta, so it should typically be harder down and harder up. But that's not a big significance, relative outperformance, especially when you highlight how parabolic gold was moving in terms of its performance. And I think year on year, you probably got gold beating Bitcoin. I must check my facts on that one. I will have to do that maybe later and confirm. So yeah, wait a bit. If you're investing unleveraged, dollar averaging, absolute winner, and stacking now. Good prices now. You don't have to pick the exact bottom. And also probably not as wild a mania queues to stand in. There have been some queues at some places, and premiums will be less. So that would be my technical take, just quick flyby. I don't know if you want to come back on anything there.
I think one of the things a lot of analysts are pointing out is that gold had 9 weeks in a row up, and that paralleled what we saw before the 1980 blow off top. But is your thought that this is not the top for gold because of all the fundamental bullish factors we still have?
100% nowhere near the top. You can never be certain, so I just committed a crime by illustrating, so I'll change it down to 99.99%. Here's my reasons why you can't even possibly be close to the top. One of them is this Cayman Islands narrative, a massive Ponzi that still has to clearly blow up and will leave absolute collateralized damage on everyone, and that's shown to be preservation of capital trade, gold. The other reason is gold-silver ratio. There hasn't been a silver bull market officially yet. Until silver starts outperforming, you're still in the range of the mid-70s to 80s on the gold-silver ratio. In fact, you might have had, with silver going down more, you've had the gold-silver ratio probably creep up in favor of gold recently. So it's even going the wrong way. This is the first leg of everything. You have to think, how far are we on debt truly being marked to market for its true value, and inflation, which is much higher in my opinion. We've spoke about the liar stats of labor, and we've said the next expose will be on the fraudulent inflation numbers, which are clearly illustrate that bonds are not paying sufficient yield. They've been over-proliferated and deeply, deeply suspect of value. So in all things, how much safer is the system? Until you get the system which is completely deleveraged, and now with confidence, all the rubbish has been burnt out, all the brushwood has been burnt out by the Great Fire, that the grass can grow back green again, and you've cleared decades, a 40-year financialization of everything from 1980 to 2020, which has reversed into the gold epoch now, and that's the financial investment time. We are the first innings or two in a 9-13 innings game, in my opinion. And I see, and I will repeat, a single-digit overreactions dip in the gold-silver ratio as the first moment that I will start rotating out of silver. Sitting here in the 80s, we're a long, long way from anything like that. And I think not only does silver clear our targets, and I reiterate our 333 first target, not final target, and the fact that we will make the 90s and there'll be a pause just before running the 100 as very aggressive calls. We see a 4-digit for silver, and I think people are going to be shocked by what gold will be. Literally, I think it goes beyond the hundreds of thousands before this entire crisis is over. So this is properly early innings, and you should expect a number of events like this as this whole thing plays out, until literally Europe, America, the Western world is on its fiscal knees, and everyone is talking about the redrawing of the power matrices in the world. You haven't got there yet. And it's sad that it has to come with the death. We're all Westerners in a way, as European, heritage people. But that's how it's got to go. And gold is our only savior in all of this. It's our only smiles in what will probably be a humility event for most Western nations.
Well, Francis, we really appreciate your time today. As always, our viewers can find you at themarketsniper.com, also on Twitter or X and YouTube. Are there any last thoughts you'd like to leave with our viewers?
There's a real opportunity to ensure that you and your offspring can secure yourselves financially. Unfortunately, there is an overreach by statism phase going on, as their ability to issue debt, which was taxed by sleight of hand through inflation, has been removed. They have to become more aggressive and more totalitarian. The most affected by this are the Western nations, which most of us are, that are watching this material, and you can expect tax scavenge mode. Our whole reason for existence is supporting people like you to secure greater wealth during very unique opportunities. The scale of the crisis is also the scale of the opportunity for those that are correctly positioned. It is going to be a polarizing event. Those that understood what's going down and acted, and those that didn't. And you really need to get this decision right. This is the game that you have to. Our whole YouTube channel and our community is focused about securing your wealth, protecting that wealth, and buying yourself real arbitrage and freedoms across multiple jurisdictions during this totalitarian major macro reset period. That is our reason for existence. I was born for these times. You were born for these times. And you can play a blinder, run this obstacle course, bring your family along with you. You only need one person to have acted prudently and taken action and maximized. And just for people that think just stacking is enough, the accelerated ability to accumulate through your stacking using HVF method and what we do through trading has advanced the wealth of our community substantially, with many taking 6- and 7-digit sums out of the market in the most recent run-up in gold that they've then converted into accelerated stack. And that's what I want for you. Secure your entire generation's wealth. That's what we're focusing on doing. And buy yourself freedoms. Utilize that wealth to secure yourself options in countries outside of the West. Thanks for having me on, Elijah. Always a pleasure.
Fantastic. Once again, thank you so much for your time today, Francis. You have a good day and God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 27th through November 3rd, 2025, while supplies last. First this week, 1 ounce gold Valcambi Combi Bars that can be broken into 10 1/10 ounce bars are just $215 over spot. Next, 90% constitutional silver is just 30 cents over spot per ounce. Finally, assorted silver rounds are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.